Whether you're an experienced investor or just starting, there's no better guide than Warren Buffett, one of the greatest investors of all time. Today, we're diving into 12 common mistakes every investor makes, mistakes even seasoned professionals fall into, but that you can avoid with some valuable wisdom from Buffett himself. This video is packed with advice straight from the investing legend, so be sure to stay until the end to soak up all the essential lessons. And before we jump in, don't forget to hit that subscribe button and turn on notifications. It means a lot to us, and it helps us continue to create valuable content for you. All right, let's get started on making smarter, better-informed investment decisions. One of the most powerful tools an investor can use is compound interest, a concept Warren Buffett has always emphasized. However, many investors either underestimate its importance or fail to take full advantage of it. The power of compounding means that your earnings generate even more earnings over time, creating exponential growth. Imagine you plant a tree today. Over the years, that tree grows bigger and produces seeds that grow into more trees. This is how compound interest works. Your investments generate returns, and those returns reinvest to generate even more returns. Buffett himself has famously said that compound interest has played a significant role in his incredible wealth accumulation. However, one of the most common mistakes investors make is starting too late or interrupting the process by withdrawing funds prematurely. Many young investors believe they can always start later, but the truth is that the earlier you begin investing, the more you benefit from compounding. How to avoid this mistake? Start investing as early as possible, even if it's just a small amount. Allow your investments to grow and compound over time. Don't interrupt the process by cashing out too soon, as that cuts the potential exponential growth you could see over decades. Buffett has repeatedly warned against trying to time the market. Many investors make the mistake of trying to predict when the market will hit its peak or bottom, hoping to buy at the perfect moment. The reality is that market timing is incredibly difficult, even for professional investors. Buffett has famously stated, "The stock market is designed to transfer money from the active to the patient." The market can fluctuate unpredictably in the short term, and reacting to these swings often leads to poor decisions. The danger lies in trying to jump in and out of investments based on short-term volatility. In fact, research shows that missing just a few of the best-performing days in the market can drastically reduce long-term returns. How to avoid this mistake? Instead of trying to time the market, focus on consistent, long-term investing. Buffett's philosophy is simple: stay in the market for the long haul. Time in the market is more important than timing the market. Avoid jumping in and out of investments and trust the long-term growth potential. In the world of investing, it's easy to get caught up in the noise of daily financial news. Markets are constantly reacting to political events, earnings reports, and economic forecasts. While staying informed is important, reacting impulsively to short-term news can lead to costly mistakes. Buffett has always been known for his ability to filter out the noise. He focuses on the long-term performance and intrinsic value of the businesses he invests in, rather than the fluctuations caused by daily headlines. Short-term news can drive emotional decision-making, leading investors to buy or sell based on fear or excitement rather than sound logic. How to avoid this mistake? Remember that most short-term news is just noise. Stay focused on the long-term fundamentals of the companies you invest in. Don't let daily headlines dictate your investment decisions. Instead, focus on the bigger picture and trust in the long-term potential of your portfolio. Diversification is one of the most commonly touted principles in investing. While diversification can reduce risk, over-diversifying can dilute your returns and make it harder to outperform the market. Buffett himself has said, "Diversification is protection against ignorance." This means that investors who don't fully understand the businesses they're investing in tend to spread their capital across too many different stocks to minimize risk. The issue with over-diversification is that it can reduce your ability to focus on the best-performing assets. If you invest in too many companies, it becomes harder to keep track of each one's performance, and your portfolio becomes less efficient. Instead, Buffett advocates for investing in a few strong, well-understood businesses. How to avoid this mistake? Strike a balance between diversification and concentration. You don't need to own hundreds of different stocks to reduce risk. Focus on quality companies that you understand and that have strong potential for long-term growth. This approach allows you to maintain a more focused yet diversified portfolio. One of Buffett's most important pieces of advice is to never invest in something you don't fully understand. Too many investors make the mistake of jumping on the latest trends or buying into businesses they know little about. This can lead to poor investment decisions because they lack the knowledge to evaluate the true potential or risks of the company. Buffett has famously adhered to a philosophy of staying within his circle of competence. This means he only invests in businesses he understands thoroughly. By doing this, he avoids making risky decisions in industries he's unfamiliar with, even if those industries seem popular at the moment. How to avoid this mistake? Before you invest in a company, take the time to fully understand its business model, industry, and competitive landscape. Stick to businesses you know well and avoid speculative investments in sectors outside your area of expertise. It's easy to get swept up in popular investment trends. When you see everyone around you buying into a particular stock or sector, it can be tempting to follow suit. However, Buffett advises against following the crowd. Instead, he emphasizes the importance of independent thinking. He famously said, "Be fearful when others are greedy and greedy when others are fearful." The problem with following the crowd is that by the time most people are buying into a stock, the price has already surged, meaning you're likely buying high. On the other hand, when the crowd is selling in panic, there may be opportunities to buy quality investments at a lower price. How to avoid this mistake? Avoid herd mentality. Do your own research and make decisions based on your individual investment strategy, not on what everyone else is doing. Often, the best opportunities are found where others are not looking. Markets are inherently volatile, and downturns are a natural part of investing. However, one of the biggest mistakes investors make is selling in a panic when the market declines. During market corrections, many investors react emotionally and sell their holdings, locking in losses that could have been avoided by staying patient. Buffett has always maintained a calm demeanor during market downturns. He sees these periods as opportunities to buy quality stocks at lower prices. His advice is simple. Don't let market fluctuations scare you into making hasty decisions. Instead, think long-term and trust that the market will recover. How to avoid this mistake? When the market dips, take a deep breath and avoid making knee-jerk reactions. Stay focused on your long-term goals and remember that market downturns are temporary. Selling in a panic often leads to realizing losses that could have been avoided by holding on. Leverage, or borrowing money to invest, can amplify your returns, but it can also amplify your losses. Many investors make the mistake of taking on too much debt to invest in risky assets, hoping to maximize gains. If the market turns against them, they may face significant losses, and in some cases end up owing more than their initial investment. Buffett is known for his conservative approach to investing and has always advised against excessive leverage. He believes that it's important to avoid taking on unnecessary risks, and that preserving capital should be a priority. His philosophy is summed up in his famous quote, "The first rule of investment is don't lose money. The second rule is don't forget the first rule." How to avoid this mistake? Avoid borrowing money to invest unless you are highly confident in the investment's potential and are prepared to manage the risks. Even then, it's best to avoid over-leveraging, as the downside can be devastating. Every investment should have a clear exit strategy, whether it's reaching a specific financial goal, hitting a target stock price, or simply reassessing the fundamentals of a company. You should know when and why you'll sell. Many investors, however, enter the market without a plan for when they'll exit, leading to either holding on to investments for too long or selling prematurely. Buffett's advice is to invest in businesses with the intention of holding them for the long term, but also to be prepared to sell if the fundamentals of the business change. Having a clear exit strategy ensures that you can make rational decisions when the time comes to sell, rather than being swayed by emotions. How to avoid this mistake? Before you make an investment, decide on your exit criteria. Whether it's a specific price point, a certain level of growth, or a long-term financial goal, having a clear plan will help you make better decisions and avoid emotional selling. The lure of high returns is tempting, but Buffett warns against chasing after investments that promise extraordinary gains in a short period of time. Many investors fall into the trap of investing in speculative stocks or assets that offer the potential for high rewards, only to experience significant losses when the market turns. Buffett's investment philosophy revolves around patience and long-term growth. He looks for solid, stable businesses that offer steady, reliable returns over time, rather than chasing the latest hot stock or speculative bubble. His approach is based on consistency and minimizing risk. Rather than focusing on short-term high returns, prioritize investments that offer steady, consistent growth. Remember that long-term success in investing is about patience and discipline, not taking unnecessary risks in pursuit of quick gains. Dividends are one of the most powerful tools for growing wealth, yet many investors fail to take full advantage of them. When a company pays dividends, those payments can be reinvested to buy more shares of stock, which then generates even more dividends in the future. This process of reinvesting dividends allows your portfolio to grow exponentially over time. Buffett has long been a proponent of reinvesting dividends. By doing so, you can benefit from the power of compounding, allowing your portfolio to grow faster. Failing to reinvest dividends means missing out on one of the most effective ways to build wealth over the long term. Always reinvest your dividends. Many brokerage accounts offer automatic dividend reinvestment programs, so take advantage of this feature to allow your portfolio to grow more rapidly over time. Perhaps the most important lesson Buffett teaches is the value of patience. Too many investors expect quick returns and become discouraged when their investments don't perform as expected in the short term. However, successful investing requires a long-term mindset. It takes time for businesses to grow, for investments to appreciate, and for the power of compounding to work. Buffett's famous quote, "The stock market is a device for transferring money from the impatient to the patient," highlights the importance of staying the course. He has often held investments for decades, allowing them to grow and compound over time. Adopt a long-term mindset. Understand that investing is not a get-rich-quick scheme. It requires patience, discipline, and a commitment to sticking with your strategy through market ups and downs. And there you have it. The 12 common mistakes that every investor, even the most experienced, should strive to avoid. Warren Buffett's wisdom has stood the test of time, and by following his advice, you can increase your chances of achieving long-term success in the market. If you found this video helpful, don't forget to hit that subscribe button. It really helps us out and allows us to continue bringing you valuable content. And while you're at it, hit the notification bell so you don't miss any future videos packed with insights and strategies from the greatest minds in investing. Let us know in the comments which mistake surprised you the most, or what other topics you'd like us to cover. Thanks for watching, and until next time, stay patient, stay focused, and keep investing smart.